Good morning, everybody. Welcome to the next in our series of accredited CPD courses, which are brought to you by the K3 Hub and Tolly. My name is Marie Wadeson. I'm a Managing Director here at Quantuma, and on behalf of our parent company, K3 Capital Group, I'm also responsible for the K3 Hub. K3 Hub is a member network for professional advisors developed by Quantuma and other companies within the K3 Capital Group. Since we launched earlier this year, over 1,500 like-minded members across the country have joined the network. Through the hub, you can access a range of CPD and training sessions, not dissimilar to today's event, and also referral fees for certain types of work referred into our group. I'm very pleased to be joined today by Val Stewart. Val is our trainer for today's session. Val has spent over 20 years working with accountancy practices, helping them to develop their business. She also lectures widely on auditing, management skills, and assurance services. She's also an author of, or co-author of, many technical guides. In today's session, Val will broadly cover the main business issues to consider for audit in respect of trade, HR, sales, supply chains, contracts, and imports and exports, and also financial reporting developments and expectations. A few practical notes: the Q&A function is open, so do feel free to ask Val questions. She'll pick those up as she goes along. If in the event she's got too many, she will come back to you separately afterwards. If you could just record your questions in the Q&A, we've got a team sort of sat behind the scenes who will pick up those questions, and if we're not able to come back, we'll pass the details on to Val. In the meantime, thank you to you all for joining. Thanks in advance for Tolly for today's session. We hope that you enjoy today's session. Have a great weekend when it arrives. And without further ado, I'm going to hand over to you, Val.
Morning, everybody. I hope the weather by you is a little bit nicer than it is around by us. We've certainly starting to move into that transition between autumn and winter, I think, here now, with lots and lots of wet and windy weather, but there we go. Okay, so the impact of audit on accounting and audit. Sorry, the impact of Brexit on accounting and audit. What I'm going to cover during the session today in terms of the brief that I had, I'm going to talk to you about regulatory issues. I'm going to talk to you about some specific accounting issues, and then I'm going to spend some time towards the end of it talking to you about audit issues. The session is timed for around about 3 hours. I'll look to take a break so that you can all have a comfort break and make yourself a cup of tea or coffee around about halfway through the session for about 15 minutes, and then we should be finished by 12. So without further ado, I'm going to start on to some of the regulatory issues. Now, there's a whole plethora of information that's out there in terms of what it is that we need to do, but I think that sometimes some of these things we don't really keep on top of in terms of making sure that we're aware and that we haven't forgotten about some of the issues. So hopefully within here, some of it's going to be familiar to you. Some of it is going to be stuff that you're that you might think, oh yeah, I need to make a mental note to make sure that that's not going to be an issue for any of my clients. One thing that I will say on here is that although I might at various stages mention the issue of tax or VAT in terms of they're not my fields of specialty, as you'd know from the introduction that's been made, and so I won't go into any specific detail on those because I don't want to confuse the issue with less knowledge than I've actually got. Okay, so on the regulatory issues, then just as a reminder here, the transition period ended on the 31st of December, and so from there on in there have been changes that came in immediately or filtered in over the period. I think most of the changes have now come about, but from the 1st of January 2021, effectively we were out of the EU, and then we started to see either immediate impacts or trickle down impacts over the period of time to see the changes actually bedded in. So one of the first ones that we had in terms of what it is that we're doing, which sounds really odd in terms of where we are, is that, you know, now UK companies that are required to or choose to apply international accounting standards, so IFRS rather than doing FRS 102, will need to switch from saying that they're applying IFRS as adopted by the EU to IFRS as adopted by the UK. So Initially, that's actually quite straightforward. I suppose you're just saying, well, we're just changing 2 letters in terms of what it is that we're disclosing, but as usual, it's not quite as straightforward or quite as simple as that in terms of the impact and the considerations. So in terms of the transitionary legislation that was put in place, the UK legislation provided that all IFRSs that had been endorsed by the EU on or before the transition date, the completion date, became UK adopted IFRSs. So what we did is we took a period of time and we said, okay, at this point in time, we're freezing it and we're saying we're not making any changes to them at all. We're actually saying that those EU adopted IFRSs are just going to, for UK purposes, be renamed as being UK adopted IFRSs. So you know, generally speaking, not too much of a change apart from the name. But then after the 31st of December 2020, that's when it starts to change and become not necessarily more complicated, but to put us into a position where there is a possibility that the UK adopted IFRSs will differ, hopefully not significantly, but differ slightly from the EU adopted IFRSs, because after the 31st December 2020, any new or amended IFRSs require independent endorsement in the UK to be part of the suite of UK adopted IFRSs that can be applied to UK companies. So any of the changes that are coming about from there on, there might be a sort of like a slight timing difference. My expectation would be that they're not really going to be, unless there's something that is very, very specifically not relevant to the UK or is very EU oriented, if you like. I can't see that we're actually going to move away, because we're looking obviously to have some consistency across the board in terms of the in terms of the accounting treatment that are being used. So to deal with this, what happened was the Secretary of State, who has the power to endorse new or amended standards for use in the UK, have delegated that responsibility to the UK Endorsement Board. So within the slides, and I think you have the package of slides have been put into the chat group for you, that's a hyperlink there to the UK Endorsement Board. So you can actually go there and look at what the activities are, so that you can see what's happening within there. So that's been enacted through the International Accounting Standards Delegation of Functions EU Exit Regulations 2021. So we've had lots and lots of little bits of regulations. So now that UK Endorsement Board is up and running and able to carry on with what it's doing. So what they've done then in terms of the brief for the UK Endorsement Board is that they have certain endorsement process criteria. So once it's there, and obviously they will be involved in terms of the international standard setting as well. So, you know, they'll have a voice in terms of what's happening there. So my expectation would be, as stuff starts to come through, we're not going to have radical differences or positions where they haven't been adopted. But what they have to do in terms of their brief is to consider for any new or potential standard that's being adopted, whether the standard is contrary to the principle that the accounts must give a true and fair view. The use of the standard is likely to be conducive to the long-term public good in the UK, and the standard meets the criteria of understandability, relevance, reliability, and comparability. So effectively, anything that's there for them to endorse it, they have to look at those 3 fundamental questions and determine that, yes, this is something that's going to, I suppose, add to the presentation of financial statements within the UK. So that's our major bit in terms of what it is that we've got to, or one of the first things that we have to think about in terms of this is that now if you're doing IFRSs, you're going to have those 2 different sources in terms of where it is, and we've got to make sure that we actually make the appropriate disclosure within the notes. So when you're looking at the accounts, and we're looking at some of the impacts within the accounts, in terms of the basis of preparation, the companies will have to disclose the basis on which their accounts have been prepared. So probably for the vast majority of the ones that you deal with, you're still going to be looking at FRS 102, 102 1A, 105, and there'll be no difference in terms of the way that we actually put those one together. But for ones where they are going for IFRSs, then there's a sort of like a transition period in terms of what it is that you've got to do. So the first one would be that if you've got accounts that are prepared for accounting periods beginning before the 1st of January 2021, but they straddle that completion date. So they straddle the 30th of December 2020, or the completion day occurs before the end of the period for filing the accounts, then normally if the company is preparing accounts based on IFRS, the account should state that they've been prepared in accordance with international standards in conformity with the requirements of the Companies Act 2006. So effectively what you're doing there is you're actually, I suppose, being a bit vaguer for the fact that you've actually got that transition period that's gone through. If the company has transferable securities admitted to trading on the UK regulated market, and is required to produce consolidated accounts to satisfy the regulatory requirements, then those accounts should state that they're prepared in accordance with international financial reporting standards adopted pursuant to regulation EC number as it applies in the European Union. So I haven't said to you what the number is. So, you know, if you've got one of those companies where they've got transferable securities, then you'd need to make sure that you have that disclosure within it. Then for accounts prepared for financial years beginning on or after the 1st of January 2021, the accounts of all UK companies preparing IFRS accounts should be referenced as being prepared in accordance with UK adopted international accounting standards. So that's what we'd said before. So you'll have that sort of transitionary period as you're going through until we actually solidify into the final version that will apply now for our December 2021 year ends and going forward. For a UK company, if they've got a listing in the EU, and they'll need to comply with the requirements of that regulated market. So accounts will need to be prepared and be described as being prepared in accordance with EU adopted IFRS or IFRS as issued by the IASB. So, you know, again, we just need to make sure that we get all of that wording right. You may have noticed, or you may have seen in certain other areas as well, including things like data protection, them talking about equivalence. So in terms of equivalence, what they're doing there is they're saying, well, actually, although we might now split it and we've got different regulations, we have a confirmation that what we have within the UK is equivalent to what they've got in the EU. That equivalence has to go in both directions, if that makes sense. So we could confirm in the UK that the relevant legislation that we're referring to within the EU is the equivalent to what we've got in the UK, but we also then have to have the individual states within the EU confirm that they believe that what we have within the UK is equivalent to what they have at the moment. So in terms of what we have for equivalence, we've agreed that EU adopted IFRS is considered equivalent to UK adopted IFRS for the purpose of UK markets and the Companies Act 2006. But as we might normally expect, at this particular point in time, the EU has not yet determined whether UK adopted IFRS is equivalent to EU adopted IFRS. That will come, but I think that because they actually have a more complex structure in terms of what it is that they're going to do, it was the same with GDPR. We actually confirmed the equivalence before it was confirmed by the other EU members, because it's a more complex agreement, and probably because they're still not that happy in terms of what we decided to do when we left. On the covenant side, things that you need to watch out for. So we started off in terms of those bits and making sure that we understand what it is that we're going to adopt. As I said to you already, where we are at the moment, there isn't a change. As we start to bring more IFRSs in, then there may be a little bit of a staggering. So we'll have some slightly different disclosure requirements if we're doing EU adopted IFRSs to what we'd have if we were doing UK adopted IFRSs. But because I think that people are sort of seeing over a period of time, in some respects, when you're dealing with a client in these circumstances, one of the things that you definitely need to do is to make sure that any sorts of legal agreements that you might have and so on, that would have an impact on the business, an impact on any disclosure that they need to make. And we come a little bit later on, an impact in terms of the audit requirements and the audit procedures. Then one of the things that we need to do is to make sure that we are happy that there is there's nothing within any of the agreements that we've got that is suddenly going to mean that we're breaching covenants, or we're breaching those agreements because they haven't been amended to reflect the fact that there has now been a change in the relevant regulations, or in certain circumstances the relevant legislation. So the first one there is looking at it and saying, if you've got covenants, loans or agreements, then they should be reviewed. So anything that you've got where there is that sort of agreement where it might specify things that are accounting related, then make sure that you're happy that any references to EU adopted IFRSs have been changed to UK adopted IFRSs, so that there isn't a possibility of an inadvertent breach to any agreement. Okay. So a minor little thing in some respects, but something that could be significant if there's a problem with anything a little bit later on. In terms of other main legislative changes that we've got in company law, where it previously referred to EEA, so the European Economic Area, or an EU regulated market, those references have been amended to refer to the UK only. So of course, what we've got now is we've got a narrower definition in terms of what's going to be relevant for those types of entities. It does have some key implications, or some significant implications, some of which I think have actually sort of people have missed a little bit in terms of what it is that they're doing, and those are going to be considered over the next few slides. But the first one in terms of that would be the issue of any consolidation exemptions that might be relevant within the business. So you may, hopefully you are aware that the Companies Act exempts an intermediate parent company from the preparation of consolidated accounts in certain circumstances. So effectively what it would mean is if you have a more complex group, so you've got A at the head of the group, and then you've got B coming down below it and C coming down below it, both of which have got their own subsidiaries. So effectively A is the ultimate holding company, but you've got two levels below that where you've got entities that themselves are holding companies. Then in those circumstances, provided that they meet certain criteria, the B and C companies would not have to produce consolidated accounts where their results are being consolidated into company A at the top. So we've been used to that for a while. So under the old regulations, so under Companies Act 2006 section 400, before it's been amended, a UK intermediate parent with an EEA parent, so somebody who was within the European Economic Area, would be exempt from the preparation of consolidated accounts, and the sort of subject to the fact that those accounts were being consolidated if it was a medium-sized or group or above, that the accounts were being consolidated by A, and that there was a disclosure within the sub-subsidiary, within the sub-holding companies, there was a disclosure within their accounts to say that the results had been incorporated, the whole group had been incorporated into the accounts of the ultimate holding company. Okay, that reference now has changed to a UK parent. So that's quite a big change there, meaning that a UK intermediate parent who's got an EEA parent will no longer be exempt under section 400. So they can't take that as saying this is okay because it's, you know, so we've actually broadened that out. So there is a possibility that if you've got companies, and probably it's not an unusual structure in terms of what it is that you've got where you've been taken advantage of that consolidation exemption at the lower level on the basis that you've got maybe a German or a French holding company. And what you're going to have to do now is to look into say if you've been taking advantage of that under section 400, then because that ultimate holding company is not within the UK, then there is a possibility that Group B and Group C in that example that I was giving you before are going to need to prepare consolidated accounts for the subgroup. There is, however, a possibility that they won't. So under Companies Act section 401, as an alternative to 400, so most people would take the advantage from under section 400 to start with. Now they'd have to look at 401. A UK intermediate parent with a non-UK parent is exempt from the preparation of consolidated accounts, subject to certain conditions, which includes the consolidated accounts of the non-UK parent are prepared under UK GAAP or equivalent, or UK adopted IFRS or equivalent. So again, at the moment, you'd probably say, well, that's going to be okay because we have that equivalence agreement in terms of what we've got with the EU adopted IFRSs and the UK adopted IFRSs. So provided that that equivalence stays, they stay in harmony with each other, then there's a possibility that those sub-holding companies, so company B and C that I was talking about before, would still be able to take advantage of the exemption from preparing consolidated accounts. And the only change that you'd need to make in terms of the disclosure would be in respect of the fact that you're saying that the exemption has been taken under section 401 as opposed to section 400, which is what we might have had within there in the past. So, you know, at the moment, that's going to be okay. But if the parent has applied a national GAAP, so maybe French or German GAAP in its consolidated accounts, then there needs to be more careful consideration of whether the basis of preparation is equivalent in all material respects. So of course, that's like us in terms of us having IFRS 102 accounts. You know, they are consistent with the equivalent within other countries, but the real consistency really stays with the IFRSs. So I suppose your argument would be in these circumstances that if they wanted to take advantage of that exemption, then potentially the easiest route for them to do, instead of going for local GAAP in terms of what they were doing, would be for them to go for the EU adopted IFRSs and the UK adopted IFRSs in terms of what they're looking at. And I hope that makes some sense to you in terms of what's there, but I think it's a case of making sure that you're comfortable and that you're happy, and you know, maybe that you don't remember all the time all of the points that are here, but that you have those flags. That means that you know that you've got to look a little bit more carefully when certain circumstances apply, so that one of the first things that you're doing when you're looking at something where there is an international an international picture in terms of where the ownership is and what the disclosures have been and so on in the past, that what you're doing is you're looking at it and you're saying, okay, let's have a look within here and make sure that we're not being caught out or finding suddenly at the last minute that we've got to produce a set of consolidated accounts where we weren't expecting to do that because the rules have changed. Okay. The other thing to consider in terms of what it is that we're looking there is that in the case of where we've got overseas subsidiaries, so where we have, so what I've talked about so far has been in respect of UK subsidiaries of EEA entities, but we can also have the reverse. So we might have a UK parent where they have EEA subsidiaries, so European Economic Area. So that's broader than just the straightforward EU. That's also an intermediate parent, and it could be that the EEA intermediate parent will no longer be exempt from the preparation of consolidated accounts because the UK is no longer an EEA member state. So again, we know what it is for our legislation in terms of where we are, whether if 400 doesn't apply, that 401 might apply, and we've just got to make sure that we're happy that those conditions are met. But when we're dealing with EEA member states, then obviously it will depend in terms of what it is that they've got in their own specific local jurisdiction regulations. So an example in terms of one that has been noted is that an Italian intermediate parent that's also a subsidiary of a UK parent would previously have been able to claim exemption from the preparation of consolidated accounts under a provision that's comparable to 400, but there's no provision comparable to Section 401 in Italy. So that may no longer be available in terms of what it is that they're doing. But in Germany, for example, they do have the equivalent of Section 401, and so it may still be available. So I think that your issue in terms of dealing with it where you've got that reverse, it's probably easier in terms of looking at the UK, a UK subsidiary of an EEA, but when you've got the reverse, when it's a UK holding company with EEA sub-holding companies in terms of what it is that you're looking at, then what you're going to have to do is to look at the state that that's in and consider whether they have an equivalent provision within their legislation to our Section 401 of the Companies Act 2006, which allows them to be exempt on the basis that the accounts are being prepared on an equivalent basis. And obviously they'd still need to consider whether they have been prepared on an equivalent basis. And maybe you'd argue in terms of this that it's a stronger argument for people to go away from doing the locally based accounting standards and move towards doing IFRSs when they're involved in this, or perhaps look at the structure of the group to see whether they can simplify it a little bit so that they're not bringing in more regulatory and accounting and auditing requirements into companies that otherwise wouldn't have needed it. Okay. So obviously then moving on in terms of some of the other changes that we've got. So for small and then medium-sized companies, so the definition of what is an ineligible group, so a group that is that is not able to take advantage of the exemptions that are available to small and medium-sized companies and groups, including audit exemption in terms of what it is that they might have. Previously then, an ineligible group was one that included an entity with shares traded on an EU regulated market. So remember, that was a change that came about maybe 4 or 5, no, actually longer than that, several years ago, when they actually changed the definition of it, because an ineligible group used to be a group that included a PLC in the UK. And of course, at that point, that meant that if you had a group that included a vanity PLC, so one that wasn't listed, was never going to be looking to list, it was just called a PLC because that's what they decided that they wanted to do, then that actually had an impact in terms of all of the members of the group, in terms of whether that entity could be considered to be small, whether it could be audit exempt. They changed the rules to say that in that case, a PLC in its own right would still itself not be able to call itself small, but if the group itself was small, the impact was only on the member of the group that was the PLC. It wasn't on all of the individual constituents of the group. So you could have a situation within a group where, you know, if you've got 3 companies, one of them was a PLC, 2 of them weren't, but globally they were small, then the PLC would have to abide by the non-small company reporting requirements and would need to have an audit, but the other 2 members of the group wouldn't. So it sort of it eased it. We then got that change that came through that talked about, instead of it just being about the PLC, that it was an ineligible group was one that included an entity with shares traded on the EU regulated market. That reference now has changed to a UK traded entity, which makes that definition much less restrictive. So I suppose you could argue that for this one, that will actually allow some of those exemptions to actually broaden out to more companies. A company then that qualifies as medium is not required to produce a Section 172 statement, for example, as any audit exemptions. And again, that exemption's available to companies that would be entitled to medium-sized companies regime, same for being a member of an ineligible group. So the change in definition may mean that companies being able to take advantage of that exemption, as well as having said about the audit side of things as well. On the dormant company side, then, dormant companies not required to prepare or file individual accounts when certain conditions are met, including the existence of a statutory guarantee by the parent of all the subsidiaries' outstanding liabilities at the year end. Prior to those amendments, the parent giving the guarantee had to be incorporated in an EEA state. So again, it had to be part of the European Economic Area. That's now changed to a parent being registered in the UK. So that one has made it more restrictive. But in terms of this circumstances, you know, if you deal with that, the parent company doesn't have to be the immediate parent of the subsidiary. So if you've got the dormant companies within the UK, and we'll come on to look at subsidiary audit exemption next in terms of what it is that we're looking at. But if you've got the dormant companies that are there, a simpler one in terms of where it might be is that you might want to actually change their ownership across to a UK-based company if you have other UK-based companies, just so that that exemption can be put in place. Okay. On the subsidiary audit exemption, then, I don't think there's ever been a really huge take up on this, unless it is really a subsidiary that's almost like a branch. So if all of the dealings or the major dealings in terms of the subsidiary company are with the holding company or other members of the group, then I think that sometimes people will actually look at it and think, yes, this is a worthwhile exercise to take. But then where the subsidiary company maybe trades in its own right, so it's got its own bank loans, maybe its own creditors that it's got, then sometimes when people actually look at it, it seems like a good idea at the time, but when they look at the position and they think, yeah, but we've got to give guarantees in terms of what we've got for the subsidiary, then often entities will actually back out in terms of what it is that they're looking to do. But we do have this audit exemption, which has been around for some time now, and a subsidiary could be exempt from audit when certain conditions are met. So which includes the statutory guarantee by the parent of all the subsidiaries' outstanding liabilities at the year end, which is why I say that sometimes when people, you know, they'll think it's a good idea, and then when they look at it and they think if they've got a rental agreement or they've got other things that might broaden out the guarantees that wouldn't normally be in place, then they'll look at it and say, actually, no, this is not something that we want to that we want to do. Again, like it was with the dormant ones, prior to the amendments, the parent providing the guarantee had to be incorporated in an EEE state, so in a European Economic Area state, and the subsidiary included in the consolidated accounts prepared in an equivalent manner. So effectively what you'd be doing is that if you had if you had a group that had a German holding company and they had a subsidiary within the UK, the group was not eligible for audit exemption. So effectively what would normally have happened would have been both of the companies had to have an audit, and then the UK subsidiary accounts would be consolidated into the German company. In terms of this exemption, if the guarantee is given by the holding company, that has to be disclosed within the subsidiary company's accounts, and the subsidiary company doesn't need to have an audit. Of course, one of the other things that would put people off sometimes from deciding whether an audit needed to take place would be the significance of the subsidiary to the group as a whole, because the issue that you have in terms of what it is that you're dealing with is that within the holding company, obviously when you're doing the audit, because they have to consolidate their accounts, there would be a requirement for you to consider the figures within the UK subsidiary. So if that was a material subsidiary, you might not be doing an audit report in terms of what it is that you're doing on the UK subsidiary, but you would still have to do adequate work for you to be able to determine whether the way that had been included within the accounts was reasonable. I suppose the issue would be that if, as I said before, where maybe it's more attractive is where it's like a branch, and so most of the transactions are actually going through, all the supplies are coming from the holding company and so on, then the ability for them then to be considering that as part of a whole and to be doing an audit without it being something that was a significant amount of work would be quite easy. But whereas if it's an independent unit where they're actually trading independently, then sometimes they'd look at it and they'd say, well, actually, it might save a little bit of money because we don't have to have a full-blown audit doing on this, but in reality, the amount of work that we have to do, coupled with the risk of the guarantees that we're giving, doesn't make this exemption something that is going to be worthwhile in terms of what it is that we're doing. So prior to the amendment, it had to be the guarantee had to be given by an EE member state company, and the subsidiary needed to be included in the consolidated accounts that were in a equivalent manner. That's now changed to the parents being registered in the UK. Again, the UK parent doesn't have to be the immediate parent of the subsidiary, so you can actually put in a structure so that you're consolidating, that you're doing it if you've got more than one. But if it is just one entity that's within there, then that exemption now may not be available. It might mean that what people want to do is they want to change the way that the structure's working. So you see within some groups that what they've decided to do is to actually drop some of the subsidiary companies. So effectively, they're just saying, look, this is something that we're not going to, it's not relevant for us really. So it's something it becomes more of an administrative nightmare for us. So it's better for us to actually look at it and to have effectively a branch over here rather than a subsidiary, which then means that we don't have to, we've got more control in terms of the way that we're actually doing it. But if you do have any entities that you deal with where they have previously taken advantage of those exemptions or they've talked about doing them, then this change in terms of the way that it's actually operating needs to be something that is discussed and thought about at an early enough stage that you can determine whether an audit is actually going to need to take place in terms of that particular entity, or whether you're going to have to or whether you're going to be able to make some changes within the structure to make it so that you can still lessen the amount of the administrative burden that's there in terms of what it is that you're doing. Okay. And I wanted to talk a little bit more in terms of the accounting side and sort of some of the regulations in terms of what it is that we're looking at within that. So you may have recognized that sort of we did have and perhaps initially this was harder. It became easier when we went over to FRS 102 because there was less of a difference between what we had within IFRS and what was within FRS 102. So a company can switch from IFRS to UK GAAP, provided that 5 years have elapsed since the last time it switched from IFRS to UK GAAP, unless there's been a relevant change in circumstances. So, you know, sort of, it's a little bit like extending accounting period ends, for example. So you can shorten them every year if you want to, but you can only extend the accounting period end once every 5 years, unless there's a good reason and an authorised reason for you to actually apply to have that that change to do the extension. So the relevant circumstances that they'd put within these place would be an entity ceasing to be traded on an EU regulated market, and ceasing to be a subsidiary of a parent whose securities are traded on an EU regulated market. So, you know, if you've got a change in the structure of the company, which you might have, we just talked about that in the previous session, then they can potentially make that change going forward. So just remember that. That's changed to UK regulated market now from the EU regulated market, which then restricts the opportunities for a company to switch back to UK GAAP. So, you know, sort of, we'll just have less circumstances where that one is likely to happen going forward. I already said this one a couple of minutes ago. Normally, you know, generally a company won't be able to extend its accounting period more than once in any 5-year period, unless it's acquired by a UK parent with a different year end. Again, previously that was available to subsidiaries of EU undertakings. And in terms of this one, whereas what I've talked about so far has been effective for accounting periods beginning on or after the 1st of January 2021, that change came into effect from midnight on the 31st of December 2020. So again, you know, sort of now, if you've got a subsidiary of an EU undertaking where there is a change in their accounting reference date, then that wouldn't automatically trigger the UK subsidiary being able to change its period end or extend its period end if it's already done it once within the last 5-year period. That would only now be available to a UK entity. Okay. Now looking at the non-financial information statement that you might have within certain company accounts where you've got those, where they're in the scope of having to produce non-financial information statements, the exemption is only available to a subsidiary if its parent prepares consolidated strategic report containing a group non-financial information statement. It's a UK requirement, and therefore no exemption for subsidiaries of EEA parents that prepare a management report, even if the content is similar. So in terms of what we've got there, we've got perhaps a little bit more information that would be needed to be produced within the accounts. For limited partnerships then, a member of a qualifying partnership would be exempt from the requirement to prepare accounts for the qualifying partnership and append those to its own filed accounts now only if the qualifying partnership is consolidated by a UK entity. Again, previously that exemption was available for qualifying partnership that was consolidated by an an EEA entity. So probably not a significant number of entities that you deal with that will fall into these areas or these requirements, but just making sure that you know, sort of where you do have any international connections within the group in terms of what it is that you're doing, that you make sure that you're happy that the changes won't now have resulted in you having to do more, or will make exemptions that were previously available to you unavailable now. I want at this point to start moving on to look at some of the accounting issues. Now, I've already said to you, in some respects, we're going to see more of those and maybe more divergence coming through as time goes on. But as things stand at the moment, because of the fact that if you were doing IFRS, there is that equivalence now between the UK and the EU ones for the ones that are in place at the moment. But as new ones come in, that might change. And within FRS 102, that still keeps a weathered eye in terms of what's happening within the international marketplace. But again, now they will be looking at the UK adopted IFRSs when they're looking at the updates that they're doing to FRS 102. And so if those start to move away from what we've got within the EU, then FRS 102 will start maybe at a slower pace at the moment, but we'll actually start to move away from that as we're going through. But at the moment, there are going to be things that when we're producing accounts for the first time, under whichever regime that we're going to do, that we need to think about the impact of Brexit and whether we've got appropriate and relevant disclosure and treatments within the accounts to deal with those changes that are coming through. And so these next few slides are actually just reminders in terms of things that you need to think about and what it is that you need to do. So for the accounts disclosure side, I've started off with a strategic report. I think a lot of the stuff that we're going to be looking at in terms of the Brexit impact is going to be around some of the narrative reporting that we've got within the financial statements. And we do need to make sure that it's more than just a one-liner, in the same way as we've got. And maybe I'll say this when we're talking about the audit side of it as well, that to a certain extent, for a lot of businesses, the double whammy of having had COVID at the same time as we've got Brexit coming through, you know, maybe would mask some of the differences that we've got. So maybe it will, you know, sort of it'll mask some of the impacts that it's had, because you can't really pinpoint precisely how much of that is actually coming about as a result of Brexit and how much of it is coming about as a result of COVID, or a combination of the two things together. Because obviously COVID is not just impacted on us, it's impacted on other countries throughout the world, as well as ones throughout the EU. And as a result of that, you know, sort of like a knock-on impact of that across the companies can be quite significant. So, you know, to a certain extent, when you're actually looking at the disclosure, you should try and uncouple them as much as you can, but you may find yourself in a position where you're having to talk about those two things almost hand in hand with each other, because you'd know, for example, some of the labour issues that we have at the moment, you know, sort of some of those are going to be around the fact that there isn't as free movement in terms of the labour. But in addition to that, you know, we know that despite Brexit, that during the time of COVID, that people perhaps were more likely to gravitate back, if they could, to where their home was. So, you know, sort of if you had people that have been working over here for a couple of years and they were distanced from where their main family was based, then they might want to actually move back there. So, you know, is the fact in certain areas where we've got less of a pool, you know, a lot of it might be due to Brexit, but a lot of it might also be due to COVID, in terms of that being the final push that's meant that people have decided that they want to move back to wherever their home base would be. Okay, so within the strategic report, the types of things that we need to look at within the fair review of the business, we need to think about having in there an explanation of the impact of Brexit on the current year's performance. And it should be clear and balanced in terms of what's there. And so that clear and balanced side of it, again, is, you know, sort of like making sure that you're actually thinking about all of the things that have impacted the business during this current period, and you know, sort of maybe looking some of that in the in the light of what's happened with COVID as well. So the fair review of the business, not just a one-liner in terms of what it is. And I know that for some of you, I'm not sure exactly what all of your positions are, but because of course we have a variance in terms of what it is that we've got. So we may have people that are financial controllers within a business, and so you're the people that are responsible for it. And we might have people that are accountants that are actually helping their clients to prepare the accounts. And if you're doing an audit, having to audit some of the information that's there. I would say that that quite often I think that what's within the strategic report for businesses is not as robust as it should be. And I think that probably within this 12-month period, as we're starting to see accounts prepared where we've got the full first year's worth of impact from what's happened, because a lot of the talk that we'd have had coming up to this period is going to be about what might happen, once Brexit happens. What we've got now is we're coming up to the end of a full year where businesses can say we've got a full year's worth of us being out of the EU, and we've started to get a better idea in terms of what some of the issues are going to be and what the problems are. And so I think the expectation within there would be that within that fair review of a business, that there is something that that looks at it. I think it's an interesting one because there's a mindset to a certain extent that's actually looking at it and saying, but we don't trade with the, our client base and our supplies are all UK based. So in actual fact, we don't really need to think about Brexit in terms of what it is that we're doing here, because we're not reliant upon sales through to the EU or to a supply chain that's coming in from the EU. But I think that some of the things that have been widely reported in the press over the last several months in terms of the shortage of lorry drivers, in terms of it's in certain sectors where we've been quite reliant upon people that have come in from some of the UK areas. So I live in North Lincolnshire, and sort of within parts of Lincolnshire, they have always had quite a transition of workers that have come in to do some of the fruit picking and sort of some of the harvest, some of the flower harvesting and various other bits and pieces that have come. And I think increasingly, perhaps even leading up to the Brexit time, they started to find that it was harder and harder to get people that were coming through, now, because we don't have such a free movement of staff. And so we don't have that fluidity either for people to be able to say, well, what we do is we go to this country for months X through to Y, and then we move on to the next country because the seasons are a little bit different, maybe the harvests are a little bit different, and so they take their skills across Europe. Maybe now for some of those people we're not part of the stopping point anymore in terms of what it is that we're doing. So and then we've got whatever type of business it is, even if what you do is you say, well, my main source of supply will be within here, you have that trickle down effect, don't you? That sort of if the person that's supplying you is reliant upon bringing stuff in from other European areas, and that started to become either more expensive or less available, then sort of that has that trickle down impact. And so I think that for some people where prior to the 31st of December 2020, they were nervous about what was going to happen, but they didn't really have a full take in terms of what the final impact was going to be in terms of the operation of their business. I think that now we're coming towards the end of the first year, where uncoupling that from the impact that COVID has had on the business may be very difficult, but they are starting to see what the difficulties might be, and they've got a fairer idea in terms of what the impact is going to be for the business going forward into the future. And so I would also say in terms of this is that this is just my view in terms of what it is that I think, but I think that when things are very they're uppermost in the thoughts in people's minds. So when they're looking at stuff, when they know that we've had two major things that have had major impacts in terms of the operations of businesses and people's lifestyles, everything that's happened over this last 12 months, I think that there's almost an expectation within a set of accounts that there should be a mention of that, irrespective of whether the business feels that there has been a significant impact. So I think that for businesses that have weathered the storm of COVID, that they're looking at the end of it and they're saying, well, actually, this really hasn't, it's been inconvenient and it's caused us a few problems, but in actual fact, it's been, sort of a little bit of a blip. And now that things are starting to move out of a more restrictive lockdown, we can see that things are going to go back to a perceived normal relatively quickly along the line. Then maybe they should still be saying stuff like that. If you've got businesses where when they start to look at it and they start to pick things apart and they start to look at what's happened within this last 18 months or so, this difficult time period, and they're doing their fair review of the business, that they can look at that and they can say, yeah, okay, we've had some impacts and there are some things that have happened as a result of Brexit, but we've, we've changed this and we've done this, which has meant that the impact of that, hopefully going forward, is not going to be so significant. I think that people are going to be looking more at that type of commentary within sets of financial statements, and that maybe they will make assumptions that the business doesn't want them to make if they don't actually mention it. So unless they specifically say, we don't think that Brexit, we don't think that COVID has actually had a long-term significant impact in terms of the operation of the business, unless they start to say things like that, then maybe people will make their own assumptions and think, oh, well, yeah, so that's going to be going through difficult times. We're going to have some problems in terms of what it is that they're doing. So the fair review of a business, encouraging, if it's not you that's doing it, encouraging your clients where you're the accountant or the auditor to just say to them that this is what it is that you should be thinking about it. This is what it is that you might want to do. And one of the things that I'd often say to people, and I think that with strategic reports, I think that it's not a bad idea, is that sometimes people, especially ones that are at the smaller end of businesses that are required to actually have a strategic report, they do struggle a little bit in terms of making sure that they have something that is a robust and meaningful disclosure within the strategic report. I don't think that there's any harm in directing them towards some examples of similar businesses in a similar sector to theirs that might be larger businesses, and to look at what it is that they've put within their strategic reports, so that maybe they can get some ideas in terms of the types of things that might be more meaningful going forward. So, bit of a rant in terms of what it is that I'm saying there, but I don't think that a lot of businesses take enough time to think about the impact that this that this might have. And not everybody's going to be looking at the narrative, but you will have people that are interested in what's going on within the business that are going to be looking quite closely at the narrative that is in place. And in those circumstances, sort of like maybe it's wrong to say unfavourable decisions, but so maybe their view of the business can be improved by making sure that you've got a more robust strategic report. So the fair review of the business to start with, then we need to look at the description of the principal risks and uncertainties. And so that one is one that is more, that's also forward looking in terms of what it is that they're doing. So the review of the business is looking at what the current situation has been and what their experience has been in terms of the impact that Brexit might have had. And if they can, try to uncouple that from COVID, if they can, in terms of what they're doing. But now in the principal risks, what they're required to do is to provide a description of the principal risks and uncertainty facing the company. And that itself should include only those that are principal or key to the business. So, and it might not include a reference to the UK's EU exit, where it's considered to be negligible or not significant to the business. But up to you in terms of what it is that you do. I think you have to consider it. And then, so whether you're the preparer or whether you're the auditor in terms of what it is that you're doing, then when you're actually looking at that, you'd have to say, well, what do we think here? what do we think in terms of the UK's EU exit? You know, sort of what areas have they got, and you know, broaden it out beyond customers, because I think that that's where people sometimes get themselves too hung up, is they start thinking about, well, I don't trade and I'm not reliant upon the EU for my sources of supply, nor am I reliant on them for my customers. But if I'm working within a sector, so say I'm in I have care homes. So if I'm a care home business, in terms of what it is that I do, you know, within there, if I'm in the hospitality sector, you know, within those, that again, as well as some of the food production and all of those, that the businesses themselves have been reliant for a long time on an established pool of workers from other EU countries, and if they don't have that pool of workers anymore, if they're competing more for them, you know, we've seen within quite a few of the sectors that, you know, where probably we have, and you can say this is right or wrong in terms of whatever your viewpoint is within here, but I was doing some shopping in Lidl about 10 days ago, and they were advertising for shop staff, so not at any sort of supervisory level, but for people that were going to be doing the shelf stacking, the warehousing, that were going to be working on the tills, and traditionally those would have been minimum wage jobs, and the amount that they were advertising for payment was for those people. And remember, we live in a rural area, so we're in, you know, we're in an area where you'd say that maybe the cost of living is a little bit less than it might be in other places, so the salaries tend to be lower than they would be in some of the big cities and so on. But they were advertising for staff at £13.50 an hour, which is higher than the newly announced living wage that is that is going to be coming in, and a couple of pounds higher. Now that might be a good thing in terms of what that is, but if you're a small shop, or even some of the bigger shops, and that's being advertised, then you know that in itself starts to set a benchmark that's there, that increases the maybe what it is that you've got to pay. If you're in a sector where you use people that are low paid workers in terms of a lot of the stuff that you're doing, so you know, sort of some of the care home people that have, you know, I think been very badly treated to a certain extent over the last 18 months or so, they've not been well supported in terms of where it is that they're doing it. Maybe they'd look at it and they'd say, well, if for what I'm doing I'm only being paid £10 an hour, and I can go and I can work at Lidl and I can be paid £13.50 an hour, then even though I really love my job, that is a significant uplift in terms of the money that I might be able to do. So I think that in terms of that whole thing around the principal risks, whatever the businesses are, whatever their connection is in terms of what it is that they're doing, there has to be some consideration for people to look at it and to say, what's this going to mean for our business? You know, we might be able to get the people in that we need to work for us, but if we can get them in only by increasing the wages that we're paying to those people by 10%, 15%, maybe 20% in terms of what it is that we're doing, then what's that going to look like for our model? You know, as we're actually trying to work that through, how's that going to see for us? Are we going to be able to pass those costs on to other people, or is that going to be a real stretch in terms of our margin? Or are we going to have to be maybe making some efficiencies so that we can expect more out of the people that are actually working for us anyway? So, you know, maybe some of these things are a little bit common sense in terms of what it is that you're doing, but I think that taking that time to discuss it, where you're the accountant or the auditor, to discuss it with the clients at an early stage within the process, so that there's an expectation, there's the ability for them to be able to think about it and to consider it. And if you're the person yourself, you know, if you're the finance director of the business, to actually look at that and to take a realistic view in terms of what's happened, and also to remember probably that, you know, sort of within the fair review of the business, people have an expectation within this last 12 months that perhaps a lot of businesses are going to have struggled a little bit more because of the dual impact of COVID and Brexit. But some of these things, as we start to wash our way out of what's happened with COVID, we can see that there's going to be more of a long ongoing and long running impact in terms of the impact that it's going to have on some businesses. And we need to make sure that we're addressing that adequately when we're thinking about the risks and uncertainties. So description of the principal risks and uncertainties facing the business, thinking about those that are principal or key to the business, but broadening out your thought process and not just dismissing it as a result of saying, well, you know, we don't really trade with them or whatever. So it could include the impact of our exit where it's considered to be, it may not include where it's considered to be negligible or not significant to the business. But I think that your thought process has to be to actually go through that and to say, is this or has it been? And when we get a little bit later on, there's a few things that, you know, sort of like in terms of whether you have an audit or not, there's a few issues within some of the considerations from an audit risk perspective that you can actually filter back through into thinking about the impact on the financial reporting as well. And still helpful for companies to explain the facts and the basis for the conclusion reached, given the importance, which is what I've said to you before, you know, sort of, I think that sometimes being silent on it is, you know, sort of, but if you say that, you know, sort of that there is a perceived risk in terms of this, but because of these steps that we've taken or because of this nature of the business, there isn't, you know, sort of they're not expecting it to have a significant risk, then you know, you're fine. If it's more significant, then companies would be encouraged to make clear and company specific disclosures explaining the facts and the circumstances. I think that the strategic report should always be specific in terms of what it is that they're doing. So, you know, if it's about, so I suppose what you're doing is you're saying, well, what could the impact be on the business in terms of us doing our assessment? Is the impact likely to be around about access to markets, whether that's for buying or selling? Is it going to be access to staff, which allows us to be able to continue in operation? Is it going to be access to finance to a certain extent in terms of what it is that we're doing? Is it going to be the possibility that we're going to have a change in the regulatory picture for the business? And so, you know, sort of maybe that'll make us harder, or maybe the combination of us, if there's more of a relaxation in the rules within the UK, if we want to be able to attract business from the EU, is that going to actually make things more complicated for us because of the need for us perhaps to have something that is more robust within the business, which might make us less attractive to some of our UK customers? So, you know, all of those sorts of things that they need to do, and they need to make it clear to think about all of the circumstances. And boards then, so the board of directors within companies are encouraged to provide explanations of how they are managing or mitigating those risks. You know, and again, if you're thinking about the people that might be the users of the financial statements when you're looking at them, then if you start to put too much doom and gloom in there without saying, but we're dealing with this by, yeah, you don't have to give away any trade secrets. You just need to say, you know, and maybe you could argue that just identifying that you have an adequate awareness of what the risks might be is a significant move, but it's just about making sure that that it's clear within there what you've done and how you've done it. Obviously, when you're doing the strategic report, it won't just be those in terms of the risks. You're going to have risks that might be your interest rate risks, or your, you know, and some of the other risks that you've got. So if you look at things like the interest rate risks, if you say that some of the push that we've got in the economy at the moment around the fact that we do seem to be seeing some wage inflation in terms of what's going through, if you think that some of that is around the fact that there is less availability of people to be able to do the jobs, which then automatically means that it becomes a seller's market rather than a buyer's market, which might itself push the prices up. the wages up, which then has a knock-on impact in terms of moving inflation up, which then might have a knock-on impact in terms of moving our interest rates up to try and stop people from spending. We get into one of those vicious circles, don't we, in terms of what it is that we're doing. So, you know, sort of just remember that some of those where we start off with just something that says, oh, you know, this is starting to happen because of COVID, or this is starting to happen because of Brexit. And then the knock-on impact of that actually increases the risks and our exposure in other areas as well. So, so you know, just make sure that you have something within there that talks about how it is that you're managing those, which, you know, the management of them can be the monitoring of them so that you know when it is that you've got to take actions. And then if you've got actions that you can take that will actually mitigate those risks. So, you know, so maybe in terms of interest rate swaps, or in terms of if you think that there's a currency exposure in terms of, you know, sort of it's so now not just in terms of what's happening within the UK, but the combined impact of Brexit and COVID on other members of the European Economic Area might in itself result in there being a little bit more volatility in the foreign exchange markets. And so if that's going to be the case, then it might be that some businesses, if they trade significantly in other currencies where they might not have done it before, they might actually start to look at forward currency contracts so that they can at least I suppose limit their exposure in terms of not having the exposure to the volatility. So, you know, it's like people when they decide to go onto a fixed rate mortgage or a fixed rate borrowing in terms of what it is that they're doing, they might pay a slightly higher rate of interest than the rate that we've got at the moment. But if what they're doing is they're protecting themselves against the volatility of future interest rate increases, then that in itself might make that a decision that's worth taking. So, you know, sort of just make sure that you're actually managing things across the whole spectrum in terms of what you're considering, and then determining the significance of the items and the necessity for you to actually have more disclosure within the accounts. Then we've got information on the main trends and factors likely to affect the future development, performance and position of the company's business. So it's a company law requirement for the director's report, but that can be included in the strategic report if that's what it is that you want to do. And, you know, sort of again, just thinking about the stuff that we've got. The business model side, just required for quoted companies and voluntary for those following the Financial Reporting Council's guidance. So again, you don't need to put that in, but given the Brexit implications, that can be quite wide ranging in terms of what it is that you're doing there. So things like people, workforce, legal, IT, pricing, finance, tax, supply chains. So a need to explain within there the extent to which the business models are resilient and flexible so that they can actually deal with all of those variants in terms of what it is that you're going to do. So I think a lot more thought needs to be put into the production of and the content of the strategic reports as a result of what we've got with Brexit. And as I say, I think that quite often my take would be when I see sets of accounts, I think they end up being one of the last things that is considered. But in actual fact, because, you know, sort of when you're already preparing the accounts, or you're having the accounts audited, or you're doing the audit of the accounts, you'll already have the figures there. There'll always already be an understanding in terms of what's happened during the year and where we're likely to be going forward. And so there's no reason why you have to wait until the accounts have been finalised before you can start to put together the meat of what's within the strategic report. And so I think that if you can encourage people to start thinking about that at the start of the job rather than halfway through or 3/4 of the way through when you're coming up to deadlines, and then people are accepting something that is perhaps less than they'd consider to be reasonable, then I think, you know, sort of you just need to be careful in terms of what it is you're doing. And the viability statements when they've got them, so where they're required, it'll be a key additional consideration. So not just thinking about any direct impact on the viability statement, but disclosures on assumptions applied in assessing the company's viability may also need to be reviewed, because obviously those assumptions may now bring in some Brexit related issues, you know, which could be some of the things we've already talked about in terms of the volatility of exchange rates. It could be about the pressure, the upwards pressure on salaries within the workforce, is something that you'd need to make sure that you'd considered. Now thinking about some of the accounts disclosures, so going into the more specifics in terms of where it is that we've got them. I think the thing to remember as we are at the moment is that although there are certain Brexit related changes to company law, no new accounting and financial reporting requirements that relate specifically to the EU, to the UK leaving the EU. So, you know, obviously some of the things that we've talked about earlier in terms of subsidiary and dormant company exemptions and so on, in terms of the adoption, what accounting framework is being adopted, you need to make sure that you look at that and ensure that the wording that's being used is the correct wording. And even, you know, if you're going for exemptions from the consolidated accounts, for example, that if now you're actually taking that exemption on the basis of section 401 of the Companies Act, that you're putting that into the accounts rather than section 400 if the holding company that is preparing the consolidated accounts is outside of the UK, then you need to make sure, just in terms of your tidying exercises, that you're happy that the correct references have been made. So if you don't, hopefully, if you use the company's accounts disclosure checklist when you're doing your accounts, then that will actually be incorporated within that. If you don't use a company's accounts disclosure checklist, then perhaps you need to just think when you're dealing with a company, particularly where it's one that is part of a group that is operated across the EU, that you actually just put together yourself a little mini checklist just to say, look, these are things that we need to check and make sure that we're actually referring to the right things within the accounts. So nothing specific apart from some of the things we've talked about already, but there is likely to be additional consideration as a result of Brexit to existing financial reporting requirements. So some of the things that we need to actually make sure that we're considering those properly. So especially, and maybe you'd say that there is an increased emphasis in terms of judgments and estimation as a result of the audit standard changes as well. But you know, maybe you need to have a focus in terms of looking at the areas in the accounts where judgments and estimation are key, and make sure that you're happy that that the impact of that has been considered. So this is not a it's a reasonably comprehensive list, but it's not going to cover absolutely everything that could have an impact. So I think, again, you know, sort of some of the things that you've got to do is to look at it and to say, okay, do we have areas where judgments are being made that that the impact of Brexit is going to have an impact on the way that we actually apply those judgments, which could be significant to the financial statements. Then again, I think that when you're at the planning stage of producing the accounts, then you need to make sure that you're thinking about that. I think that, you know, I've already mentioned that it adds significant market uncertainty or adds to significant market uncertainty that was brought about as a result of COVID, which is, you know, potentially going to continue for another through another 1 or 2 reporting periods, in terms of the not being able to see or to think about the full impact that it could have. It's likely to put substantial pressure on financial statement measurements and forward-looking assessments in terms of what it is that you're doing. So we just need to think about those. So the first one would be in terms of the measurement of non-financial assets. So thinking about any assumptions underpinning recoverability of the value of assets such as goodwill, intangible assets and property, plant and equipment. So you need to carefully consider those, given that double hit in terms of what it is that we're doing. So, you know, just thinking about it to say, And again, some of it will depend upon the sector, and some of it will depend upon the area of the country that people are operating in. You know, if you've got goodwill within an entity, and what you've had is you've had a significant downturn in terms of what's happened within the business, are you still happy that that goodwill exists, that it hasn't been significantly impaired, that the policy that's being adopted to amortize it over its useful life is adequate, or that the useful life doesn't need to be revised in terms of what it is that you're looking at? So I think that, you know, looking at all of these aspects, looking at the property, plant and equipment, and thinking about whether, you know, whether there needs to be a change in terms of some of the things that you've got, thinking about in terms of some businesses, you know, whether they need to look about the changes that they've made to accommodate safe working during the COVID times. You know, how many of those things are actually going to still be in place going forward? If we've put those in as our normal fixtures and fittings, and we're depreciating them over a 5-year or a 10-year period, are we actually still going to be using them in 5 years or 10 years time? Or should we, and particularly if they've been substantial, should we actually be looking at depreciating those over a shorter time period to reflect the benefit and the use of those assets within the business? So I'm thinking in terms of those about with businesses where they're using screens either internally between individuals to make sure that they can give people safe distancing in terms of what it is that they're doing, or in ones where they're customer facing, and you've got the perspex screens that are in place, so that there is some division between the person that's doing the serving and the person that's actually the customer. You know, are those actually going to are they going to be dispensed with? They're going to carry on being used? You know, some of the temperature scanners that you've got as you walk in and out of office buildings or some shops, are people going to where they put in fixed stations for people to be able to do hand sanitizing and all the rest of the bits and pieces? Are those now going to be seen as being something that is in people's way, and so they want to move it out of the way? Or is it going to be something that we're actually going to be looking at going forwad into the future? So I think that in terms of all of those, and then that can be coupled with, you know, what about businesses where you've got businesses perhaps in the hospitality sector where everybody is saying that those ones have been really, really seriously impacted in terms of what's happened. What sort of hit has that had? You know, even in terms of, you see stuff in the press and it talks about property prices, but when it talks about property prices, it's talking about residential property prices. It's not talking about commercial property prices. And so, you know, what's the impact that that's had? And is there a necessity, and especially where you've got a business that is struggling, is there a necessity for you to think about having to make an impairment to the value of those assets? So, you know, alongside that mandatory impairment testing that we have to do given certain circumstances, it's probably not just such an arbitrary consideration now, because there's likely to be more indications of impairments arising, and you just need to think about it and then, you know, and then satisfy yourself that that doesn't have a material impact on the financial statements, or if it's likely to have a material impact, that the adequate consideration has been given, adequate disclosures are within the accounts, and if necessary, adequate provision has been made against the figures. Remembering that when you're looking at the measurement, that any cash flow forecasts used in impairment calculations should be based on budgets and forecasts reflecting the economic conditions. So again, you know, when you're looking at those, when you're considering those, and we'll come on to a little bit more of that when we're looking at going concern a little bit later on with the audit side of things, you know, is that the routine that people have used in the past in terms of them putting it together, the amount of sensitivity that they need to take into consideration when considering whether what they're saying is reasonable is likely to be broader, because, you know, sort of it's going to be unclear potentially for some time, and we just need to have clear disclosure of assumptions and estimates and sensitivity analysis to make sure that people, when they're looking at it, can show that you've understood fully what's necessary. I'm just looking at where it is that we are at the moment, and I'm thinking it's 26 minutes past 10, so you've had the pleasure of listening to me for the last hour and a half. So maybe at this point, 27 minutes past now, maybe at this point people would like to take a little bit of a break for 15 minutes. So that takes us to just before 11:15. So what I'll do at this point is I'll turn my camera and microphone off. Okay, welcome back, everybody. I hope you managed to get a couple of emails done and got yourself suitably watered and fed if necessary during the time. Somebody just asked a question in terms of credit loss in this context. I think this is something I'm just going to go back onto now when we're looking at this next bit. So hopefully that will become clearer in terms of what it is that you're looking at. So I think just before the break, if I look just before I stopped, I was looking at measurement of non-financial assets, so our fixed or property, plant and equipment, and our intangibles. Now I'm looking at financial instruments in terms of what it is that we've got, and again thinking about this in terms of the fact that it could have quite wide-ranging implications for the valuation of financial instruments. So, you know, sort of our debtors, creditors, and the like in terms of that, which will relate to either market prices, so used for determining fair value for certain instruments where we're having to show them at fair value within the accounts, and the assumption used to determine whether there's an impairment of loans and receivables, so our loans and debtors in terms of doing that. So if you've got companies that report under IFRS, then they have to assess the expected credit losses that will be incurred as a result of the impact of Brexit on their customers and recognise credit loss provisions for increase in expected non-recoverability of receivables. So effectively the credit loss there is the amount of impairment that they're going to get for that, the amount of additional bad debts that they might get, the amount of additional provision that they might need to make against stock, because it's not always going to be recoverable, but it's largely in terms of the risk that you're going to have an increase in the level of bad debts that you're going to have. And then companies that report obviously under FRS 102 need to assess whether as at reporting date there's an objective evidence of impairment. So I think within the IFRS model, where what they're doing is doing more of an overview in terms of not actually looking at stuff as being a specific amount, but looking at it and saying, okay, is Brexit likely to mean that our level of bad debts is going to increase by 2% or 3% or 1%? Whereas if you're doing under FRS 102, what we're looking at there is we're looking at specific conditions, specific entities, and thinking about the level of impairment that they might need against certain of the assets that they've got to consider the impact of Brexit on that. So that would be against specific debtors that might meet certain criteria in terms of your expectations that they're maybe going to struggle a little bit more, or it's going to be harder to recover the money. Or when it comes to things like stock, whether there's certain items that are going to become less saleable as a result of what's there. I hope that that's covered your question, Simon. If not, perhaps you can put something into the chat box, and into the Q&A, and then if we don't cover it today, I can just come back and answer you specifically afterwards. Okay. Now looking at stock in terms of what it is that we've got. So the inventory side, using the international terminology, I suppose, they'll need to assess whether that's held at an appropriate carrying value, remembering that what we do is we do effectively the lower of cost and net realisable value at the reporting date. So it can, for example, it might affect directly attributable costs. So maybe certain customs tariffs, various other things that are there. So when we're determining what the ultimate net realisable value is, if there's additional costs associated with the sale of the inventories, then the point at which we might end up having to make a provision will potentially be lower. So when we're looking at it, we need to assess estimated selling price of the goods, less the estimated cost of completion and the estimated cost necessary to make the sale. So, you know, when we're looking at that NRV type of things, we've got the cost. It's not just a case of directly comparing what we sell it for what we bought it for. It's actually looking at the costs that are directly associated with us being able to sell it. So, you know, if we've got things like tariffs that are coming in, then those need to be added in, and it makes us look marvelous. Then we've got things like deferred tax assets, if we've actually got those within the accounts. It depends on the extent that it's probable that future tax profits will be available. I think we have to remember in terms of what it is that we're doing here. It's much more stringent than it used to be under the old UK GAAP in terms of what we did for the criteria that have to be met in order for us to be able to recognise deferred tax assets within the accounts. So it's one of the only areas really within the accounts we still apply an appropriate degree of prudence, which is sort of almost become a bit of an old-fashioned statement when we're looking at financial statements, I think. But when it comes to this, you know, sort of what we have to have is we have to have a clear picture in terms of if we've got deferred tax assets that relate to losses that have been made, we have to have a clear picture that those are going to be able to be recoverable in a relatively short period of time. So if we've got, say we've got £100,000 worth of tax losses, and what we can do is we can do some really relatively reliable forecasts going forward for the next 2 years. And we think that within that next 2-year period, we're going to be able to utilise £50,000 worth of those deferred tax losses, then we'd be able to recognise those in the financial statements. We can't, which we probably would have done in the past, say, well, if what we're doing now is we're turning into a period where we're expecting to be profitable, and so we think that, you know, sort of within our forecasts, we can actually see that we're going to utilise those within the next 2 years. But then the expectation would be that we're, of course, going to continue along the same vein. So we'll utilise the rest as well. If you don't have something that gives you that degree of certainty in terms of the recovery of them, then you can only actually recognise the assets to the extent that you can say, this is what our forecasts are showing, this is what our expectations are. I suppose it's not just Brexit, it's everything else that's going on. You know, sort of people may have actually looked at this in the past and they've come up with their forecasts and their expectations based on normal trading positions. And now we do have that double whammy of both Brexit and COVID coming in at the same time. And so in those circumstances, maybe what we're going to be needing to look at is to whether we have to revise our estimate as to how quickly we can actually reverse that trend, and in particular with entities where perhaps they had moved into being more profitable from being loss-making, and suddenly the events over the last 18 months or so, and what we're predicting is going to happen in the next 18 months or so, is actually putting them back on the edge again, that we might have to reverse the asset that has already been recorded within the accounts, which, you know, sort of obviously would have an impact. And just then within your narrative reporting, you need to make sure that it's clear to people what's happening and why that might be a position. When you're preparing, or the client is preparing, projections of future taxable profits, for the purpose of that deferred tax recognition, they need to reflect expectations of the reporting date. So, you know, sort of just making sure that you are being clear in terms of what your thought process is. I think I mentioned this a little bit earlier on in terms of one of the things that we might be looking at when we're producing a set of accounts, and that's with foreign exchange. So with the entities where their connection is a trading connection in terms of what they've got with the EU, rather than potentially an indirect supply issue, which is one of the things that we talked about a little bit earlier on, then, you know, sort of just considering the risk in terms of foreign exchange. Does it bring more volatility in terms of what it is that they're doing? That could be significant. And again, I think I mentioned earlier on the possibility that they might think about foreign exchange hedging in terms of trying to mitigate the level of risk that's associated with it. So again, you know, I think people are probably quite good in terms of the disclosure that they've got within the accounts of you know, sort of the calculations of any foreign exchange gains or losses that are being produced within the accounts, but thinking about the forward volatility and the impact that has on any risks that they've got. We have to think about the possibility that they might have onerous contracts that have, you know, that have not have arisen because of Brexit, but have become onerous because of Brexit and or the combined impact of COVID and Brexit together. So the definition of an onerous contract then is a contract in which the unavoidable costs of meeting the obligations under the contract exceed the economic benefits expected to be received under it. So, you know, sort of if you've got ones where contracts become onerous as a result of Brexit, where you've got obligations that the business has got that they need to fulfill, that now because of direct or indirect impacts of Brexit, those contracts are no longer going to be economically viable, but you're still bound by the terms of the contracts, then you need to make sure that a provision is required, a provision is made within the accounts where that's required. So, you know, maybe a loss of revenue, increased costs that are associated with a contract, you know, something that you'd thought, I mean, one would hope that people would have pre-thought about particularly some of the stuff around Brexit, so that they wouldn't have gone into things with their eyes closed in terms of thinking about what the impact was going to be when we had inevitable changes that came about as a result of Brexit. But I don't think that anybody, sometimes when they were planning and when they were perhaps entering into some of these contracts, that they wouldn't necessarily have identified or predicted the perfect storm of Brexit alongside COVID. So the two things actually operating together, the impact that would have had. Okay. few other things that you need to consider before we start moving on to the audit side of things for the last part of the session in terms of what it is that we're doing. Directors' duties and dividends. You know, perhaps making sure that you are happy within the company, or you're happy if you're doing the audit of a company, that they've taken adequate consideration in terms of whether some of the prudence, some of the forecasts that they're making, some of the expectations has been taken into consideration when they're looking at their dividend policy. You know, the payment obviously of an illegal dividend is, well, it's an illegal dividend, it's disclosable within the accounts, it needs a little bit of time to unwind. It's perhaps going to be, as much as anything, an issue within some smaller companies where perhaps they're, you know, where you've got owner-managed businesses where they've had a policy in the past of having salaries being paid, and small salaries and higher dividends. So the movement within the dividends is a little bit more volatile, and you know, making sure at this point in time that that businesses are thinking about their positions and are making sure that that when they're making the decisions going forward in terms of their dividend policies, that they have adequate reserves. and not just within the last financial statements, that, you know, sort of that they're keeping an eye on that as they're going forward, so that you're not getting into a position that you get to the end of the year and suddenly you've got either significant illegal dividends or significantly overdrawn directors' loan accounts as a result of more being taken out of the business than the business can afford to do. So, you know, again, that one's a combined combination in terms of the impact of both Brexit and COVID in terms of what it is that they're doing. And then going concern. Now, I put this in terms of the accounts one because I think that it does, obviously it does have an impact, and one of the primary issues that you've got is that you make sure that that it is clear within the accounts where there are uncertainties, why the directors believe that it is appropriate for the going concern basis to be applied. Obviously, we used to talk about preparing accounts on a breakup basis if it wasn't a going concern. We don't do that now. We talk about a basis that is other than the going concern basis. And in many respects, we will only do that where we believe that there is either a plan to cease to operate, and so the business is going to cease to be a going concern, or alternatively, where there is where there's no option but for. So in certain circumstances, it might be that, okay, they haven't actually started the paperwork in terms of dissolving the company and of winding it up because it's insolvent or for whatever other reasons that they're doing it. But we know that there are no options other than that, and then the accounts might be drawn up on a basis other than the going concern basis, so to reflect the fact that the business is not going to continue. In all other circumstances, unless it is very clear, which in some cases it still will be, that the business has adequate resources in order for them to continue, then we may need to have appropriate disclosure within the notes to the accounts to determine why the directors believe that it is appropriate for those accounts to be drawn up on a going concern basis. And that disclosure is quite often weak. But effectively, what you need is you need to have a statement that's within the accounts that sets out, firstly, that the accounts have been drawn up on a going concern basis. You then have details of any of the uncertainties, any of the issues that might impact on the entity's ability to continue. So you might say that, you know, sort of it's been a bad year because of COVID, that we've had all of these issues that have come around as a result of Brexit. So you're putting the disclosure within there. It might be that we've made a loss. It could be that you know, sort of that you're not trading as not as profit, you know, so that you haven't made as much profit as you have before, and so decisions have had to be made, some restructuring has had to be done, you know, maybe some debt financing has had to be looked at. And then what you do is you say, okay, these are the circumstances that we'd have to question, that we'd have to consider when we're thinking about whether it's appropriate to use the going concern basis, and these are the actions that have been taken by the directors to mitigate those risks or to deal with the problem that we've got. So it might be that we've got guarantees in place. It might be that we've renegotiated bank finance with the bank. It might be that, you know, that we're coming towards the end of the expected impact from transition. So maybe we've made some changes in terms of the way that we operate, that we've been looking at new markets, that we've been looking at new sources of supply, that you know, sort of that we're thinking that at the moment, you know, sort of what we've got is actually moving us forward. And so we believe that we're coming out of that difficult situation. And so we're going to be able to continue to trade. So you have all of that information in there in terms of what it is that they're doing and why the directors believe that it's a going concern. And then you have that conclusion at the end of it that says, as a result of that, these accounts have been drawn up on a going concern basis. So you've got the explanation that's there. It shouldn't be woolly. It should now be more forward looking, because, you know, in 12 months ago, when we were still in the, you know, we were still just going into Brexit, but we were in the middle of the lockdowns that we were having. We were just seeing the impact that COVID was having. What we were doing a lot of the time there was to say, look, you know, sort of, we're hoping that once we get out of this, it's going to get better. But at the moment, the support that we're getting via the coronavirus job retention scheme, bounce back loans, CBILS, whatever it is that we're going for, that support has actually allowed us to continue in operation until such time as we can start seeing the light at the end of the tunnel. So a lot of it was focused more on the support that was being given, that was allowing the business to stay afloat until such time as things started to open up. What we've got now, and remembering that when we look at going concern, and I think sometimes people still forget about this, is that irrespective of when it is that we're signing off the accounts, the period that we have to consider is 12 months from the date that we approve the financial statements and we're signing the audit report if an audit is being done. So as a result of us having to look at that, you know, there are still some people that have had extensions in terms of their filing deadline as a result of them putting in an application because of COVID related impacts. Normally that's what it's going to be. That what we might be doing is we might actually be preparing those accounts. We might be, if an audit's necessary, be signing off an audit report 12 months after the end of the financial period. So what we're doing is we're then looking at the impact another 12 months further on. And within that another 12 months further on, we're going to see the transition of us going out, hopefully, from seeing things normalizing as a result of COVID. But we might also start to see, as we are at the moment, where we're seeing some of the things with labour shortages and all the rest of the things, some of that, it's almost been a delayed impact. It wasn't instantaneous once we finished, once the deadline date came on the 31st of December, at midnight on the 31st of December 2020, because we had some of those transitionary period provisions that came in. Some of the impact of these things wasn't coming in until June, July time this year. And so as a result of that, we're only just starting to see the impact that some of those things are going to have. And that is going to filter through into the next 12 months as well. So when we're looking at going concern, you know, we do need to, with our non-2020 forward vision, look at it and make sure that we've considered what the position is going to be. And we need to consider whether, when we're preparing the financial statements, and when we're advising the clients in terms of what's there for the financial statements, that there is appropriate disclosure within the notes to the accounts to explain why it is, where there are uncertainties, that the directors believe that it is appropriate to apply the going concern basis. We'll talk about it a little bit more in terms of the impact of that on reporting when it comes to the audit side of things. But I think that, you know, sort of the starting point has to be to make sure that you've got a picture that is supportable, that it is that it covers all bases, if you like. So it's not just looking at one aspect of it, it's looking at the whole picture that's there. And that what's happening is that the user of the financial statements, when they're actually looking at what's there, can measure or can look at it and say, yeah, that seems reasonable. And I suppose the next thing that I wanted to say in terms of there is just a reminder to you, going concern and profitability don't necessarily go hand in hand. So a business is a going concern if it can meet its obligations as they fall due. So you could have, and I've seen this in a couple of circumstances, you could have a business that has built up a large number of liquid resources over a period of time. That means that even though they're going through a particularly torrid stage at the moment, you can quite easily look at it and say, well, you know, they've cut some costs where they can, they're doing what it is that they're doing. You know, if we're predicting that they still might end up being loss making, they can still actually continue to trade for at least another 12 months with the reserves that they've got in place. Now, there might be another decision that they need to make about whether that's the right thing for them to do. You know, is it throwing good money after bad, or are they actually saying, well, look, we've got the resources to weather the storm, and we think that once we get out the other side of the storm, we're going to have a leaner, meaner and profitable business that we can operate going forward. So, you know, if they're doing that, then that's particularly fine. So it's not necessarily tied to just being profitable. And you can have a company that maybe has a company that is asset rich but cash poor. So if most of their assets are fixed or less current in terms of how it is that they can actually get hold of funds around them, that you know, sort of they could, on the face of it, they could look as though they've got a more stable balance sheet than some other entities. But if what's happening is that they're now struggling in terms of them being able to get the cash resources they need to have, if their sales have gone down a little bit, then they don't have that flow in and out of money that's coming through. Or maybe even if their clients are struggling and so their debtors days have increased, so the cash flow is actually worse within the business in terms of what it is that they're doing, then they could be ones where there is more of an issue around going concern than ones where they're making a loss, but they've got enough liquid assets to back them up to allow them to weather the storm. So you know, just remember in terms of what it is that you're doing there, that it's not just about, oh, we only need to consider this because they've made a loss, and you know, and not for any other reasons. Okay. On the audit side, the first one that I wanted to do in terms of these, before I actually start to look at some of the audit impacts and the things that you need to consider in terms of what it is that you're doing, is to look about general audit issues. And hopefully for those of you that are registered auditors, so for those of you that are actually within accountancy practices that that provide audit services, you will have noticed, or you would have realised, that the automatic registration in Ireland has now gone. So under the old system that we had, when you became a registered auditor, you were registered to undertake audits in the UK and also in the Republic of Ireland. Now that went once we got to the end of the transitionary period. So I think most of you will have noticed that when you do your annual returns, when you do your declarations, you should have had some stuff that came through from the professional bodies. You will have noticed that you are no longer, unless you actively do and have taken steps to demonstrate that you're actively doing Irish audits, so not in Northern Ireland, but in the Republic of Ireland, then what's going to have happened during that time period is that your registration is going to have gone off of the Irish register. A couple of issues in terms of that, you know, it might not have an impact on you, but because within both of the main professional bodies in the UK, I'm sure that the Scottish Institute were the same as well, it was an automatic inclusion unless you chose not to have it before. So what would have happened is that as soon as you were qualified to be an auditor in the UK, you would be qualified to be an auditor in Ireland. And so most people had that dual one, and most people would then have had an application, or would then have had on their letterhead, so on their legend, they would have talked about the fact that they were registered to undertake audits in the UK and Ireland. So if you've got that on your letterhead and you are no longer, then you need to remove the "and Ireland" off of the one that you've got. So on your letterhead, on your emails, if you have that as a footer, on your website. So you need to go through and do that real in your letters of engagement. If you've actually talked about the two in terms of what it is that you do, then you need to make sure that that has been updated appropriately. The ACCA, because they actually have a representation in the Republic of Ireland, still remain regulators for the UK and the Republic of Ireland. So in terms of what it is that they do, they will regulate people who do audit work in both together, and they regulate people within Ireland and they regulate people within the UK. The ICAEW, who would be, again, they're the two main regulators within the UK. I know we've got ICAS as well, so I didn't, if anybody's an ICAS member and they want to ask a question, If you don't ask it of ICAS, then please send me an email and I'll check and look in terms of what it is that they do. But I suspect that they're going to be like the Institute, where what they did was they made a decision to say that they're no longer going to be in a position to monitor Irish registered firms. And so any firms that qualify and applying would need to apply to another body for registration and regulation for their Irish audits. So they could have dual regulators in terms of their audits, or I suppose if they wanted to, they could move their registration across to somebody like the ACCA, where they could actually have the dual registration with the ACCA. Where they can't have it with the Institute, they'd have to go to the Irish Institute in order for them to be able to do that, or go to the ACCA for that aspect of it. So it's a small number of people that will be impacted in terms of what it is that that we're doing here, but it is just important to make sure that you've ticked all the right boxes. And as I say, I think that they've probably given people enough notice, but I do still find that when I go around, there are still some people that haven't updated their letterheads for a while, and they're still referring to Ireland on there where they're no longer registered there. So they need to be careful. Okay. So what I'm going to do now is I'm going to talk about some of the audit issues. And I think although what I've got on the heads of some of these slides is to talk about know your client in the planning, I think that what I'll do is I'll actually, I'll probably combine, as I'm talking about this, I'll talk about some of the audit things that you need to consider when you're doing them, as well as looking at them. And what I've done within here in terms of doing some research and looking around and looking at some of the things that are being that are being put out there is just pointing out some of the questions that as a business, if you're an auditable business, you need to be prepared for your auditors to ask. So you need to be thinking about those in terms of the operation of your own business. And if you're an auditor, of some of the issues that you need to start to consider, and you need to be asking yourself in terms of, you know, sort of, right, does this apply to the business? Does it there? So it's almost like putting in a, I don't know whether you will have done it. I don't know in terms of some of the methodologies, whether they've actually got something in, but you might want to put in your own little separate checklist of issues that you want to consider from a planning perspective to ensure, and then to filter that through in terms of the impact that it's going to have on the audit, to consider whether this is relevant to the client, and if so, how it impacts on your risk, and then how it and then how you're going to audit it, or how you're going to look at it and consider it from an audit perspective to determine ultimately what impact it's going, you believe it might have on the business, on the truth and fairness of the financial statements, if there's any disclosures that need to be made, or any uncertainties that that arise as a result of it that may have an impact in terms of the entity's ability for them to be able to continue profitably going forward into the future. I hope that makes some sense to you. I put it in as know your client and planning, because if you get it right at the beginning, then it's a lot easier. It's a lot harder for you to start thinking about some of these things when you get to the end of it. So it's really important for you to think about it at the planning stage of the audit. And the know your client aspect of it is that you can't assess whether the risks apply or the impact that those risks are likely to have on the entity unless you actually have a clear understanding of how the business operates. So so I think that this is an ideal opportunity really to start beefing up that understanding that you have, not just in terms of saying, oh, well, when they make a sale, they do this and they do that, but it's about how their markets work, what it is that they, how it is that they operate, what they're reliant upon, so that you're actually looking at it with a bigger focus. It will be good preparation for the introduction of the revised version of ISO 315, which will start to impact for our 2022 period ends. Time's going very, very quickly, but you know, sort of this will just be a good start in terms of making sure that at the very start of it you're sitting down, and some of them are going to be things that when you sit down and you actually start talking to the businesses, especially if you're dealing with some smaller businesses, some owner managed businesses, You know, if they haven't done their own strategic planning, it might help them to focus as well in terms of some of the risks are. So it becomes a very beneficial part of the audit when you start to talk to your clients in a little bit more detail about this, but I think it would be quite useful. So if you look at ISA 315, which is the main risk audit standard that we have in terms of what it is that we're looking. So what they do is they're saying that you need to consider the risk issues. So you need to think about the potential risk factors that arise from Brexit. You need to think about how significant that there's a risk of material misstatement associated with those risk factors. So is it going to bring some complication within? Is it going to, you know, sort of, is it going to bring something which perhaps wouldn't have been as well controlled as some other areas would be, that might mean that you could find material error within the financial statements that's going to be significant as a result of it. You need to think about, I think, even though, you know, sort of they're two separate issues to a certain extent, I've already said this several times during the course of this session, that, you know, are the risks that are exacerbated by the dual impact of Brexit and COVID-19. So have we got things that, you know, sort of when we look at the combined impact of those, that we're looking and thinking, gosh, that's bigger. And we need to think about what audit procedures need to be performed to respond to the levels of risk identified. So at the know your client. So, you know, part of this is the doing some more investigations so that we actually have a better understanding in terms of the way that the business is operating and the impact that these things will have had. And then we get into the full planning to talk about, well, okay, if we've identified things, then what are we going to do to be able to do that? So what I've done in terms of this, in splitting it out, is to look at it and to think about things that are specific to, that might be specific to different industry sectors. So when you're looking at those, that things that might be general business risks, and then, you know, sort of like, or specific to the business, and then just some other risks that might actually come in here in terms of what it is that we're doing on. So the first one would be, you know, and hopefully you'd know a lot of these things. Does the industry rely on fast turnaround of imports or exports? So are they some of the just-in-time types of things in terms of what it is that they're doing? Or is it, you know, do they deal with perishables or pharmaceuticals, or, you know, sort of things where there's rapid obsolescence in terms of what it is that they're doing? Or have they moved, you know, as they do within a lot of businesses, have they moved over to a situation where they've got a nice supply chain that is operating, and as a result of that nice supply chain that is operating, they can wait until the last minute in terms of what it is that they do. As an end user, I'm sure that all of you have had experience over this last period where either there's been things that you would normally routinely have found within the shops that aren't there. So, you know, sort of not empty shelves across the board, but just certain items where it's becoming increasingly difficult to get them. And in certain circumstances, there's been some things where it's been difficult right the way through the, you know, for quite a long time. There's been other things where now we're starting to see more of a shortage in terms of what's happening. We'll just think about that. If the impact is now starting to come through to us when we're looking at things in the shops and so on, then go back, and that's where businesses are going to be. And so, you know, you just need to look at them, and you can look at some of the evidence that's there to suggest, but it's looking and saying, well, what do you do? You know, how are you doing it? Are you changing your purchase patterns? So instead of going back to the justin-time.com, are we actually going and saying, well, what we need to do is we need to be a little bit more forward thinking in terms of what it is that we're doing? Are we actually diversifying some of the things that we're buying and selling in order to minimize or to reduce the impact that some of this change is actually happening? How quickly can we respond to things that are just that we can see potentially going wrong? So how quickly can we actually respond to those? So do we have the source, do we have the resources or the systems to be able to identify that things are actually deteriorating, and to see whether we can take alternative action? Have we looked if some of the issue is about the source of supply, where it is that we're getting it from? Have we actually looked to see whether there is an alternative source for us, so that we can mitigate some of the risks in those ways. So we ask the question of them to determine what the likely risk is, whether there is going to be a problem. We ask them about the steps that they're taking. And then what we do is that we would design some audit tests that we're actually looking to see whether we can see that there's a deterioration in this, whether we can see that there is a greater lead time in how long it's taking them to fulfill orders that they're receiving from customers, whether we can see, you know, that they're having to, that they can no longer provide certain things that they have provided within the past. And so we can ask them then what their plans are going forward into the future, and we can think about assessing what the impact that that's likely to have, not just now on the business, but on the business development and ultimately the going concern of the business as we're going forward into the future. So that's our start point. We think about whether they rely solely on an EU supply chain or alternative supplies available domestically or internationally. So I've talked about that one already. So have they started to look at those? Have they started to look at the alternatives that are available? And even if they don't have a problem within the supply chain, are they still going to be hooked into that if there's no alternative apart from what they can get through from the EU? You know, if things get harder, and if and if it becomes more difficult for them to actually get them in to sustain what it is that they're doing, how are they going to deal with that in terms of what they're looking at? And again, we design some audit tests in terms of looking at what the validity of what they've told us the impact has had on the business, and then ultimately on our expectations going forward. How dependent are they on wider supply chains based in countries with EU trade agreements? So, you know, sort of, is that going to cause us, if we've got to be going to other countries and we're having to negotiate new trade agreements with them, where there are more complicated customs arrangements? You know, if there's a broad market within the EU that they can go to and they can trade more easily with the EU, is that going to mean that that ultimately it becomes harder for us to either buy or sell into those areas as a result of those issues? Do they rely on access agreements or licenses from the EU to operate or sell within the EU? So passporting arrangements for banks or rights to operate within airlines between the UK and the EU. So they have to have those, or within the freight trade. You know, you probably saw that before we had such a shortage of lorry drivers anyway. But if you remember that, you know, sort of UK lorry drivers would need to have the authority for them to be able to be driving within the EU. So, you know, sort of like, do we have those types of things, and has it caused a disruption for them? And, you know, how are they resolving that? How are they getting around it? Has that resulted in additional costs? Are they going to be ongoing additional costs, or are the short-term things? You know, so how's that actually been factored in? So again, you'd need to be looking at the outcome of that. Is it impacted by quotas? So fishing rights, aquaculture. So we've got any business sectors where, you know, sort of, again, maybe what they're able to do. On the fishing side of things, when we first had voted to go out of the EU, I heard this thing on the news, and it's I can't remember exactly what the precise figures were, so I'm going to make them up a little bit in terms of what I was doing, but it was certainly in both cases over 90%. What this person was saying in terms of the fishing rights and all of the activities that we have around buying and selling is that in the UK, 90% of the fish that, it's 90% plus, I believe, of the fish that we catch, we export. And over 90% of the fish that we eat, we import. So, you know, it's not as much as saying, oh, well, it's okay, we can fish in our own waters. It's about the nature of the product. And maybe some of it is going to have to be to re-educate some of the consumers to start liking or eating fish that they haven't eaten for years, because they can get something that they prefer that's fished in somebody else's waters, if that makes sense. but you know, sort of, if we've got these sorts of things, if we've got quotas, if we've got stuff that's there, if that impacts on our business, how are we dealing with that? And are we seeing evidence? If we're doing the audit, are we seeing evidence that they are actually managing those risks and have considered what the ongoing impact is going to be for the business? How reliant are they on tax grant funding or other incentives from the EU? So, you know, now that we're not going to be able to get that, is that going to cause a problem? So that might be an issue with charities. It's an issue with some research institutions and so on, that all of a sudden the fund sources are starting to dry up, and you know, it might be that there are still going to be eligibility things that they can do, so they might be able to get something, but how are they actually managing that? How are they managing to diversify what it is that they're doing so that they don't become so reliant upon stuff that is that is reliant upon the EU? Are they dependent upon general economic well-being? So, you know, if you're looking and you're thinking that we're in quite suppressed economies right the way across the world, if you like, in terms of where it is, you know, sort of, I think there's been stuff recently that's talked about the UK bouncing back quicker than anybody else, but then then you'll get the other commentary that will turn around and say, yeah, but we'd fallen further. So we had further down to bounce back from in terms of what it is that we're doing. But if you're in a feel-good business, you know, if you're in an industry that is actually reliant upon people having the money, so not luxuries necessarily, but things that people can cut back on, then how long are you going to be able to sustain perhaps a lower demand for the products that are being there? So how's that working? What are they doing? Are they trying to diversify in terms of what they do? Do they typically depend on tight cash flow management? So that filters in. So all of these things that might impact, that might make things a little bit slower, that getting the goods in might be a bit slower, that some of their customers might be a bit slower to pay, that there might be some more volatility around the exchange rates. That means that, you know, sort of like the certainty of the level of margin that they're making over some of the things that they're doing might not be so big. So if before they've always been teaming and lading in terms of making sure that they've got enough resources to actually move forward, is that going to start to, is that pressure going to be hard on the business? And from an audit perspective, are we actually seeing that happening? So are we seeing the creditors' days started to extend? Are we seeing the debtors' days starting to extend? Are we seeing them bouncing on the top end of their overdraft facilities, you know, so all of those sorts of bits that you're looking at, that you'd look at for indicators that might make you consider that there might be issues or risks associated with the business. Do they tend to have significant market linked portfolios? So, you know, sort of, do they tend to have a lot of investments and so on that are actually linked through to the markets, which could end up losing us money? Can they continue to operate in the EU without changes to the operations? So, you know, have they been forward planning enough to make sure that they've made the adequate changes that they need to make? You know, sort of, are you happy if you're doing the audit that they're on the way to making any changes that are needed, that they're actually doing what it is that they need to do, and have they, you know, have the changes that they've made, are they actually making it a smoother run in terms of what they're doing, so that hopefully they can minimize the impact that it's going to have on the business going forward? Do they rely on UK staff regularly working in the EU, or vice versa? Well, I mentioned this one earlier on, and we are starting to see this happen now. And, you know, sort of, as I mentioned when we were talking about some of the accounting issues, you know, sort of one of the things that we're starting to see is potentially a push on salaries, probably across the board, but I think most significantly in terms of the lower paid areas, which I think most people would attribute to the fact, you know, you could, well, that's what they've been saying. You know, sort of some people have been saying, oh, we had aging population in terms of people that were lorry drivers, but a lot of people have been saying that over time it became a sector that was a low paid sector. So whereas if you went back 25, 30 years, maybe it was seen as being a job and a sector that gave a reasonably good reward to the people that were working there, that over a period of time people have been looking at the weighing up the downsides of lots of driving, you know, sort of a sedentary job, if you like, lots and lots of traveling, and, you know, sort of all the stresses of more traffic on the roads and all the rest of the things that were going together. And they've looked at that and they've said, well, actually, for the amount that I'm being paid, it's not worth it. So as a result of that, a large proportion of our haulage was actually done by people who were coming in from countries where the wage rate wasn't as high. And so relatively speaking, what was being paid to the lorry drivers was actually a decent salary. Now, because of some of the Brexit issues, more of them are going back to where they were. And perhaps in some of the cases, because of a more vibrant economy where it is that they can actually get as good, if not a better reward from working somewhere else in the EU, not necessarily their country of origin, somewhere else within the EU, than they can within the UK. So looking at the staff impacts and looking at the nature of the business, looking at the people that they've got, looking at any problems that they've had during the course of the year, asking them about what their staff turnaround has been like, asking them about what the wage push is like, you know, maybe even within, because it will be different sometimes in certain geographic areas, looking at what the market is for individuals within the area, what the wage push is like within the area, and then thinking about how they're going to be able to manage that and how they're actually monitoring it, and whether they're responding quickly enough in terms of the cost push, if that's going in an upwards direction, to make sure that they're trying to ensure that their sales are actually keeping up with that cost push, because otherwise the margins are being stretched, which ultimately means that they become less profitable, which then leads to all of the other issues that we've got in terms of whether there's problems with going concern. Are what they do subject to EU regulatory and compliance law? And if it is, are they keeping up with that? Are they keeping up with the registrations that they need? Are they looking at it to make sure? Because as I said before, I think almost across the board, it's not just within accounting where what's happened is that where we've got EU-based regulations that we've done, that we have come to a, you know, we've done the passing of our ways, but we've kept them the same. But as time goes on, they might start to move further apart, which might make it more difficult if you've got businesses that aren't actually geared up to being able to keep up with what's needed there. It might make it more difficult for them to continue. And also, not just in terms of making it more difficult for them to continue, but it actually might put a barrier up that means that people, that businesses from EU countries might actually prefer other businesses within other EU countries, because they don't have to then consider whether they have the appropriate regulatory permissions and all the rest of the bits, you know, so it's easier for me to deal with somebody where I know that they're going to have harmonized rules to what I have. I don't know, I'm not a predictor in terms of what happens. My guess would be that because we still want to continue to operate within the EU in areas where it's key, we will try and still keep them in harmony so that we don't have something that means that it's not worthwhile for them to do it. My degree was a really weird one, and I did one in food marketing when I was doing my degree. And it was around about the time that we were just sort of like, we were starting, we'd been in the EU for a while, but we'd started to actually move through to some of the harmonization of laws. And because mine was in the food sector, one of the things that stuck in my mind for years is that when they came into trying to do the numbering, the E numbers for additives and for food colorings, on the food colorings in particular, and remember the EU was smaller at that point, so we had less countries that were in it. The first starting point was to go through and to see what were what food colorings were actually allowed across each of the member countries. So they were coming up with a list in terms of what it was that they did, and there were hundreds, thousands of them that were actually allowed across the whole of the EU. But there was only a handful, and I can't remember how many it was, but it was certainly less than 20 that were allowed in all of the EU countries. So it was an absolutely massive exercise for them to be able to say, well, if we want to have free trade, one of the start points that we have has to be that a product that we can sell in Germany has to be something that we can sell in France, that we can sell in Ireland, that we can sell at that point in Great Britain. So, you know, sort of it was a major exercise for them to actually get to the end result when they did, and obviously they're still looking at it. So I think that probably that will follow through to a lot of other sectors. But if you know that it's heavily regulated and you're looking at it, you know, how's that actually going to manage? What are the risks that going forward we're suddenly going to find ourselves with a lot more limited market, because we won't be able to, unless we're keeping up with what it is that they're doing in the EU, we won't be able to actually demonstrate that we've got comparable rules or whatever. Do they rely on EU labour in particular to fill business critical roles? Well, I'd already talked about that one, I think, before when I talked about the UK staff regularly moving backwards and forwards. It's not just about people working between the places, it's about people that would that would actually be your full-time workers too. The things that might be specific not just to the industry sector but to the business overall, legal and compliance issues that impact the entity's operations, are the risks of non-compliance with laws and regulations. So what are the compliance issues? So we need to perhaps have a broader consideration when we're looking at compliance with laws and regulations. It might be that we've got more now that becomes central to the entity's ability to continue. So at the planning stage, and then the impact in terms of what it is that we do on the audit and what we do. We don't have to be legal experts in terms of what it is that we do. We expect the business to actually have an understanding, and sometimes there's a common sense approach in terms of what it is that we're doing. So if you're dealing with somebody who handles food, if you're dealing with somebody who has people handling heavy machinery or various other bits and things that that they're doing, you know, sort of if you've got anybody that's within those sorts of sectors, you know that they're going to have regulatory requirements that they need to comply with. So, you know, perhaps a bigger focus in terms of what we're doing now, and where you've got businesses that either are reliant upon things coming from the EU or alternatively are actually reliant upon EU customers, then when you're looking at your considerations of laws and regulations, you need to think about whether there are now any revised or new regulatory issues that need to be considered. And then what you're doing is you're looking to the client to say to them, well, okay, if you've got to do this, what things have you got to do and how do you make sure you do them? And then from an audit perspective, you're looking to make sure that they are doing what they say that they're doing, so that you can actually identify whether there's going to be things that could cause them either regulatory penalties or in a worst case situation could severely impair the operations of the business. And so you design audit procedures to actually look at that. What effect would the provision in the trade agreements have on their ability to be able to continue? So what have we got within any trade agreements? Are they going to open up markets for them? Are they going to make things more restrictive for them? So, you know, you need to think about that and think again about what the company is doing for them to be able to deal with it, thinking about whether that's adequate, and then testing to make sure that they are doing what it is that they said that they were going to do. Will they face increased administration costs relating to importing from the EU or exporting to the EU? So not just about any duties and things like that that might apply, but also about the administration and the systems that they need in order for them to actually be able to deal with that. And is that going to be so significant that that's going to impact in terms of their costs, which will impact on their margins? And again, what evidence are you seeing to show that that's or how that's operating? Will they face increased tariffs and duties on goods exported to the EU? So the same sort of thing, you know, sort of, and how have they factored that into their costings, which I suppose is one of the reasons why we might see some bigger impacts in terms of what it is that we've got from Brexit, is because having had that double whammy of COVID as well, you know, sort of maybe businesses are a little bit more fragile. And so any impact maybe will have a significant or more significant impact in terms of what's happening on the business going forward into the future. Will they face increased tariffs or duties on goods I've imported from the EU and elsewhere? I think we've already done that one, really. Increased administration, potentially result in additional risks to the entity being able to purchase supplies, produce goods and services, or deliver its goods and services. So, you know, sort of, is that going to actually make it non-viable for them to continue to provide some of the goods and services that they are doing at the moment? How exposed are they to things like currency fluctuations, unemployment, interest rates, and inflation rates? So, you know, sort of, if they are fragile, if you're looking at going concern and you're looking at their sensitivity analysis, then how much of an issue is that likely to have on them? Lots of things to consider. How has their control environment been impacted by Brexit? So, you know, especially if they've got maybe subsidiary operations, which we talked about right at the very beginning of this, you know, sort of, are they now going to be able to have effective control over those, or is that going to be something that's going to cause problems? I think, you know, I already mentioned to you earlier on that I've seen, when I've been going around to firms, quite a lot of restructuring within the European-wide groups. You know, on some of them, they're just carrying on the way that they've always done, but in others, they've actually restructured it so that you know, sort of, they're bringing perhaps more of the operations back into one country rather than having it all in. So having like a branch in the UK or a branch in Germany rather than having it as two separate limited companies that they might have had before. Has the risk of fraud increased? I think that any changes that we have, any things that add additional complications into what we do, opens the doors to intelligent fraudsters to try and actually make money out of people. So, you know, sort of, is this causing us a problem? So, you know, is there incentive or pressure, opportunity, rationalization, that, you know, sort of, the things that might influence management in terms of the fraud internally, but also the external fraud that might be undertaken on the basis of the business. So we think about that one. Management, do they have a consistent view on what the future risks are? Have they thought about it, or are they just hoping and keeping their eyes open, closed, and looking at what it is that they're doing? So they're the main things that we have to do in terms of there. And then what we've got to do is we've got to think about some of the key areas which we also need to make sure that we're keeping an eye out for when we're doing the audit, and making sure that we've dealt with them. So things like covenant breaches, again, we mentioned those a little bit earlier on, you know, but in more difficult times, you know, not just in terms of looking at what the terms are to make sure that they're applicable now to the business, and they're not referring to benchmarks that are, you know, sort of like outside of the control of the business, if you like, or unrealistic now for the business, but also, you know, sort of, do the increased pressures that have been put onto the entity actually result in there being an increased risk that they might breach some of the covenants, which then, you know, sort of, the banks have been very good over this last 18 months period, largely because a lot of the help that they've been given has been supported by the government. But you can expect that as, you know, if things carry on and we're going through difficult times, that they will tighten their belts and put more pressure onto institutions. So you need to look at what the flexibility is that they've got within the covenants that they've got, and how close they are to the edge, which will then direct how much work you need to do in terms of looking to make sure that you're happy that there's no risk that they will breach a significant covenant. You need to think about the approach to any complex financial instruments such as interest rate swaps. So if they've got those, are you happy that, you know, sort of, you have adequate understanding. You're going to need to be looking in at the agreements that they've got to make sure that you understand those agreements. You make sure that you understand the implications, and importantly, that you make sure that there is appropriate both disclosure and provision where necessary within the financial statements for the financial impact of those entities. We talked earlier on about contract modifications, but sort of again, if the client's got significant contracts, if they're ongoing contracts, you need to be looking at them to see whether there's any indications that some of those contracts might turn into onerous contracts, which again would have impacts in terms of the financial viability of the entity, but also in terms of disclosure and provisions within the accounts, but also to make sure that there's no risk that they're going to breach contract terms as well as covenant terms, because there is terminology or provisions within the contracts that are no longer feasible or viable or reasonable in terms of the moves that we've made. So have they actually made the necessary adjustments to any contracts, that both in terms of contracts that they've got with to provide services, but also the contracts that they've got that are providing them with services, if that makes sense, so that you're happy that everything that's okay. Ongoing concern. So you have to, and with the revision to the going concern standard, we've had an obligation for some time for us to make sure that we are actually considering that throughout the audit. And I think that, again, within these times, it's really important that you're focusing on it and you're thinking about, at the start point, at the planning point of the audit, what position the company is in, what their projections are going forward, and what their consideration is in terms of what's going to happen over that next 12-month period, so that you can actually build in any of the risks that are associated with that into the audit work that you're doing. So you can look at the factors that they're reliant upon, the assumptions that they're making, and you can look to see evidence when you're doing the audit that the assumptions that they're making are actually sustainable, that they're standing up, that they're likely to carry on going forward, so that then you can be more comfortable in terms of your final conclusion as to whether the business is actually going to be a going concern. You need to, at the planning stage, think about your focus on any subsequent events. So, sort of, especially if you're doing if you're doing the audit of an entity where it's only a couple of months in to the post Brexit, so sort of a March year end or an April year end, or in a certain circumstances, ones that are sort of that now where the main impacts that are going to be on that business actually haven't kicked in until July, August time, when a lot of the transition provisions actually ended around June. Some of them are ending around now. So, sort of looking at what the situation is now to predict what is likely to be happening going forward into the future is really important, not just looking at what was happening and what the financial position was at the end of the year. And then thinking about when we talked about the accounting issues before, thinking from the planning stage about any of the issues that we've got within there that are going to require specific consideration when we're doing our audit. So for each of those, when we plan the work, and I've sort of talked about some of the things that we do before, but for each of the specific risks, as we've identified them as being risks, we need to consider the impact that it could have on the business, think about the likelihood that it's going to occur, discuss it with the client, design our tests so that we can see, we can look at how it is that we're going to actually focus on that particular area if it's significant. We look for corroborative evidence. So for evidence of the client saying we've done this and this is why we don't think it's a problem, we look at evidence to support that, but we also look for contradictory evidence. So we look at things, so if they're saying, oh, well, actually, sort of where, we know that there's issues in terms of supply chain, but we're not seeing, but we're happy that we've got all of that under control, then part of what you might do is you might look to see whether their lead time on orders has increased. You can look to see whether, sort of they're changing supply, you know, sort of whether they're changing suppliers, whether those suppliers are actually responding quickly in terms of actually fulfilling their needs and so on. So you could just go through those sorts of things, and then you come to a conclusion. You know, there's never going to be, I think, in terms of some of this stuff, a correct or an incorrect answer. What we've got to do is we've got to look at it and make sure that we've identified the risks, that we've considered the impact that those risks could have, we've considered the action that the client's taken, and how effective that action has been to actually minimize or to mitigate those risks. And then we come to a conclusion to say, yeah, okay, we're happy that this is something that's not going to have a material impact going forward. I spoke to you already about going concern, but you know, sort of again, just in terms of the audit work that you're doing on those, a remembrance of what it is that we need to do. We need to think about the availability of cash, of liquid resources that they've got within the business. We need to think about their access to markets and how they can deal with any interruptions to those, and whether they can seek alternative markets in terms of what it is that they do. We need to think about the availability of staff. And we need to think about the forecasts that they've made, and when they're making the forecasts, we need to think about how they've actually flexed those. So, you know, sort of where we're not looking at it as being normal trading positions for both COVID and Brexit positions, and we need to look at their sensitivity analysis and how good that is, and determine when we're looking at it, you know, sort of whether we believe that with close monitoring, even if some of those risks fall in, that the business is still going to be able to manage their way through what can be quite rocky times for everybody. A few other things in terms of impacts which have partly been done before. You know, thinking about import tariffs, thinking about new customs rules, thinking about clarity of contracts, and you know, who's responsible for export import formalities, duties, VAT, and so on, and GDPR, which I think I mentioned right at the very beginning of this, but you know, sort of the free flow of information. I think in terms of those equivalencies, we have now determined that we have equivalent rules, so we're happy that information can continue to flow between the EU and the UK, but you know, sort of you just need to keep your eyes and ears open in terms of that situation, because if things change, then that could also change. And then on the completion side, you know, just remembering in terms of what it is that we do, that we need to, when we're getting towards the end of the audit, that we just need to make sure that there's a full record that shows that we've considered the results of specific tests, and the impact that that's going to have on accounts disclosures, and the audit report. And the accounts disclosures will include the strategic report, which we talked about right at the very beginning, in terms of what it is that we need to do, and that we need to pay particular attention to the risks disclosure in the audit report. So, you know, again, in terms of the planning that you're doing, just remembering that with the revised ISA 700 audit report that requires us to put disclosures in terms of the risks in respect of fraud and irregularities and compliance with laws and regulations, that we have made it clear in terms of how we address those risks at the planning stage, and the types of tests that we actually did. So, you know, in particular, where you've got entities where they are reliant upon operations within the EU, it's going to be really important to make sure that those disclosures within the audit report reflect. Okay, quite a lot to cover. Hopefully relevant to all of you. I hope it's been useful. Although I haven't been able to see you, it's been nice to talk to you all. And at this stage, I'd ask if anybody has got any further questions. But otherwise, thanks for coming. Enjoy your weekend.